welcome to the podcast where we discuss about different innovative ideas in business and technology. So in this playlist or in this segment, we were discussing financial skills of a business. So in this podcast, we are going to continue the first part. So we'll learn about key financial metrics and ratios. So, welcome to the podcast. Here we're going to learn about how to calculate and interpret matrices such as ROI, profit margins, and liquidity ratios. Keeping a check on the business performance is key to successful growth. That's why in this podcast, you will learn the underlying functioning of financial matrices and ratios. We'll also learn about ROI, return of investment, profit margins, and liquidity ratios. With the help of these tools, you will be able to understand the financial performance and make informed decisions. So, we are going to cover uh, understanding the purpose of financial matrices and ratios. We'll also learn how to calculate key matrices like ROI, profit margins, liquidity ratios. We'll also explore how these matrices affect financial decisions. Financial matrices and ratios are tools used to analyze a company's performance and financial health. Think of them as a report card of businesses. They help managers, investors, and stakeholders understand whether a company is doing well, struggling, or somewhere in between. For example, if you run a lemonade stand, you might calculate how much profit you made compared to the money you spent on the lemons and sugar. This basic calculations how well your business is performing. Matrices and ratios. ROI, return of investment, means how much profit a business generated relative to the cost of investment. It's a great way to see if an investment worth it. ROI formula will be net profit divided by cost of investment into 100. Imagine you spent $1,000 to advertise your business and earn an additional $2,000 in revenue as a result. Your net profit is $1,000 and $2,000 revenue and $1,000 investment. The ROI will be 1000 divided by 1000 into 100, which is equals to 100%. 100% ROI means you double your investment, which is excellent. On the other hand, profit margins show how much of a company's revenue becomes profit after expenses are paid. There are two common types of gross profit margin and net profit margin. Gross profit margin formula will be like revenue minus cost of goods sold divided by revenue into 100. Whereas the net profit margins formula will look like net profit divided by revenue into 100. If your lemonade stand earns $500 in revenue and the cost of goods sold lemons, sugar and cup is $300, your gross profit margin is 500 minus 300 divided by 500 into 100, that is 40%. A higher profit margin indicates better efficiency in managing costs. Now we come to liquidity ratios. We'll learn what it is, and with an example, I will try to explain it to you. Liquidity ratios measure a company's ability to meet short term obligations like paying bills or repaying loans. The most common liquidity ratio is the current ratio. Now, let me give you the formula for current ratio. It is equal to current asset divided by current liabilities. For example, if a business has $1,000 in current asset and $5,000 in current liabilities, the current ratio will be 10,000 divided by 5,000, which is 2. A ratio of 2 means the company has $2 in asset for every $1 it owes, indicating strong short term financial health. Financial matrices provide clarity and focus. They help businesses to identify strengths and weaknesses, make informed decision about investment and expenses. It also helps in communicating performance to stakeholders like investors and employees. For instance, if a company's profit margin is declining, it might indicate rising costs of inefficiency. The company can take corrective actions by identifying issues such as renegotiating supplier contracts or improving processes. So now we would like to assign you a small work. Like you have to choose any of the businesses and research on the financial matrix or ratio which are helpful for the businesses to grow, and identify which of the financial matrices helped the business more flourish and it was more trustful. Have you ever seen any of these matrices helping in the real world businesses? Write down in the comment section. We would be very happy to see you there. In summary, I would like to summarize financial matrices and ratios like ROI, profit margins, and liquidity ratios are powerful tools for evaluating companies' performance. They provide clear picture of profitability, efficiency, and financial stability, guiding better decision making. So that's it for the today's episode. I hope you have learned so many things in this podcast, and we'll also continue the next upcoming chapters in the next segments. So stay tuned with us. Till then, keep learning, keep exploring.